Okay, everyone, let's go ahead and get started. Hope everyone, just want to confirm, I think my audio is coming through loud and clear. If you could just use the chat board on the right. I know Fonda and Bucky are there, Terry, Samantha, already mentioned that. Okay, just a little bit of quick background about myself. I entered the mortgage industry way back in 1998. So I would be, at this point, considered a mortgage dinosaur, I can affectionately say. And during this time, then I started Metroplex Mortgage Services way back in 2001. So just last month, we had our 22-year anniversary since I started a company. So we're really proud of that, and all the families we've helped, realtors we work with, just a huge network of family and friends, it feels like at this point. So we got our main office in Tampa, branch office in Sebring, as well as Dallas, Texas. And we're licensed throughout Florida, Texas, Tennessee, and Alabama. We've got a ton of registrations who are going to be listening to this afterwards on the live. And we are known for our government loan expertise. With that, we are a USDA and VA approved lender, which we're going to be focusing on the VA loan today. And with that comes our in-house underwriting and all the features we'll talk about as we go through the course. In addition, obviously, we have high experience with FHA and conventional, and with that comes expert credit knowledge, which is what I'm seeing right now be mainly an issue with a lot of the lender qualifications, not having the requisite credit knowledge to make deals work in today's market. As well, I'm a licensed California attorney and Florida authorized house counsel for Metroplex, and with the certified mortgage banker designation of the MBA. And anyone who's attended my classes, who has been to the courses, whether it's CE class, this is not a CE class, but I love what I do. And I have a high passion, in particular for the VA program, as well as our USDA program, which are staples in our rural housing market. And as far as we're going to explain what a VA approved lender is here in a moment, right now. So just if you use the chat board for a moment, I'd love to hear who online right now has had experience with VA loans before or who has not. There's no right answer to this. It just gives me an idea of who's got a little bit of background in this. I know from some of you that are live right now, I've worked with you in the past, and I know you've got experience with this or work with them. But anyone we're going to go through a lot of myths, a lot of the issues that we hear that are not issues with the VA program. And what we do as a VA approved lender, and how you become a VA approved lender, is years ago, I sent in a huge packet to the VA office. They go through and look at your checklist. They make sure that you meet their requirements to be a lender. And then you become an approved lender, which means you have the ability to underwrite those loans right within your office. If you're not a VA approved lender, you can still take the application and process the loan, but you don't have the underwriting authority. So the VA approved, it is a process. It is steps you go through to meet those requirements of VA. Then once you become that VA approved lender, you can work directly with the buyers, directly with the realtors, underwrite those loans as well, and really prioritize conditions that we need. If there's any questions, we can communicate directly with the VA on those unique scenarios. And this really allows us to expedite processing and underwriting and give you, as the realtor, primarily that one point of contact from qualification all the way through closing. Huge, especially in today's market, having the communication, the control in all those those channels lined up, it is critical to success. Because what we're seeing in today's market is I'm seeing so many, going back to 08 and 09, where we saw lenders exiting the business, obviously completely different circumstances, as everybody's aware. We're starting to see rampant mistakes with loans again, in part because there's so many loan officers that came in and lenders that came on board here recently. And when rates were 2.5%, 3.5%. And now as rates have gone up, you have to really know the guidelines. We're back what I call the bread and butter market. You have to know the guidelines, know the localities, know how to put these programs together, understand maximizing credit, debt to income ratio, explaining out of pocket, having those communications with home buyers and realtors that have substance to it. And they know after the call, we're headed in the right direction. We have a clear mortgage plan. So just a quick background of VA loan history. You'll see here, Won't spend too much time on this, but way back in the Servicemen's Readjustment Act in 1944. And then as you go through, VA does have a history of low default rates, despite having that no down payment. And that's some questions we get. Well, because they're putting no money down, is that a risky loan? These are fixed rate loans for the most part, no down payment, qualified veteran buyers. So we have an amazing ability. We are going to talk about expanded abilities to qualify with credit, income, debt ratios, and most important, VA provides a huge amount of affordability. Now, side by side, quickly, the government loan highlights. If you're looking from left to right on your screen, you're going to have FHA over here, known for 3.5% down payment. FHA recently reduced their monthly mortgage insurance, which is definitely helps with the affordability. USDA loans are also well known for their 100% financing. And I always say, if you can get a VA buyer who's also eligible for USDA, hold on to that buyer like Scotch tape. You stay glued to that buyer, because that gives me 2 bites at the apple, 2 different types of qualifying criteria to open up affordable housing for that veteran who's buying in a rural housing area. And obviously USDA, most of us on the call are in or around a rural area, or some of these areas are completely USDA eligible. And then VA is going to be also the no down payment financing, eligible for service members. There's no monthly cost such as PMI, but a VA funding fee may apply, which we're going to talk about a little bit later on. In today's course, I took the 2-hour CE course I had and I trimmed it up so it's a 1-hour workshop, because I want to give you the high points, the terminology. So when you're on the street talking with home buyers, you have some background, you feel comfortable. I'm not trying to get you to be loan officers or do the VA approvals or the VA qualifications or understand the 100-page handbook that we have to go through. I just want you to have that comfort level with the program, as with any of my courses, classes, and the like. So on the 100% financing here, you can see these 2 stacked side by side. We are so known for these 2 programs. We are onslaught with requests. We love them all because there's questions, scenarios through all these years. Having those question scenarios, that builds experience. So our depth of experience in my office on the most complicated programs, we are known for that. So please, any question in the chat board, throw them up there as we're going through, and we'll get to them as we get to various breakpoints. So obviously both are known for a no down payment financing. USDA has a 1% guarantee fee. VA has a funding fee, which we're going to go through here momentarily. There's no monthly cost. USDA has a small monthly premium that's included with their monthly payment. USDA loans have a unique feature where, let's say, for example, the home does appraise for more than the sales price. USDA will allow you to increase your loan amount up to that appraised value and then roll in your costs that way. So a really unique feature that we've used so many times successfully over the years. VA does not allow, outside of the funding fee, VA does not permit that same flexibility. I can't just increase the loan amount if the home appraisal comes in higher. USDA is rural areas only, and there are some income limits that apply. And VA is for those eligible service members and surviving spouses. And VA offers a tremendous flexibility through what the seller can pay and cost. As I've had these workshops and classes over the years, obviously different markets have come and gone, where let's say 12, 14 months ago, even USDA and VA were not getting even their foot in the door with offers. And then as rates have went up, I've explained to our home buyers, that was the best thing that could have happened, because that allowed some opportunities where the USDA and VA type buyer was appealing to the seller. More opportunities for the buyer, more opportunities for the sellers to accept an offer. So basically those higher rates have definitely helped open the door to get our buyers back in, at least getting offers looked at. And so if you would please, on the chat board, just in a few quick comments, let me know your thoughts on the market. I love to get this feedback. I love to hear. I know inventory is still at issue in so many areas. That's improved slightly in certain locales, depending on the area and county. But I have seen, compared to this time last year, we are getting USDA and VA buyer offers accepted in a variety of the rural areas that we work in, where just so in a recent time, those would not have happened. So if you could just shoot some chat on the board, I'd love to hear, because we get people from different areas as well. Just throw those comments on the chat board and then we'll keep the conversation going. So with VA, no monthly fee. USDA has that monthly premium we talked about. FHA loans have, if you put less than 10% down, their monthly mortgage insurance is for the duration of the loan. If you put 10% down or greater, then it cancels at 11 years. And there's the guidelines for conventional loans where the mortgage insurance can be removed at certain points based on the loan to value of that original home value purchase price. Okay, so seller concessions. All right, these are questions that are coming up more and more as we go through as the markets change and opportunities, and sellers are willing to give some concessions in order to get the property moved. And I agree with what Clarence said. The market is good, and there's some really bad VA miss out there. I agree with that completely. We're seeing just the buyer demand on our side is still high. They've become accustomed to the rates. There's no more rate shock with the current market. The demand for home ownership, especially in the markets we're in, is extremely high. So I do agree with Clarence. The market is good. It's tough. The loans we're working on are more technical. They are very guideline specific. One word here, one sentence there could mean eligibility versus not, depending on the circumstances. And part of that is the seller concessions or other seller paid closing cost. So USDA will permit up to 6% of the sales price towards those costs. FHA will also permit 6% of the sales price. VA has a unique feature where VA has no limit for closing cost. For those of you that know this, there's items called closing costs, which could be your recording fees, title insurance, loan cost, property surveys, recording fees. And then you have your prepaid items. Prepaid items are those prepaid, such as homeowners insurance premium, the escrows for taxes and insurance, your prepaid interest. VA has no limit on the actual closing cost, but they do allow a separate 4% up to those prepaids. And we can actually pay off debt with closing cost. We just had one close last month where we used excess seller concessions to pay off over $4,000 in a veteran's credit card debt on the closing statement at closing. So if you're trying, people say, Sean, how can we be creative? I don't like the word creative, but in this case, this is using guidelines and maximizing them to the fullest potential in helping the veteran and the transaction at the same time. Now, if you're working with a conventional buyer, remember there is a split on the amount of costs a seller can pay. If you're putting less than 10% down, you're capped at 3%. 10% or greater, the seller could pay up to 6%. In investment properties, you're looking at 2%. And going back to Terry's comment about it's hard because of insurance. We are seeing insurance come up. Insurance is not killing deals. You have to be, obviously that's property specific. There have been challenges with insurance. We've been able to work through them. Our buyers have found good carriers. We're good agents. We've all worked together to get deals to the closing table. So if you have any transactions that are stalling because of insurance, let us know. What's the problem? Is there roof repairs? There are some repairs we can do after closing. VA does permit that as well too, as well as USDA, where we can do an escrow holdback. Instead of the seller paying for that in advance, how that is we hold money back from their proceeds after closing with the title company. The sale closes, the buyer can move in, and the roof repairs will be done thereafter. So that's a great feature that can help keep a deal together and not count on the closing to pay the roofer at time of closing. We can have those funds secured for the contractor to be done after closing. So that's called a repair escrow holdback. I kind of jumped ahead of myself a little bit, but that's a great feature for things that items, the roofing, flooring, air conditioning unit, just to name a few. And then there's also what's called VA allowable and non-allowable cost. So allowable cost would be, and when I say allowable, this is something the veteran can pay. Credit report fees, prepaid titles, insurance premiums, surveys, appraisals, title exam, etc. Then you have the right-hand side, escrow fees, notary fees, but there is no limit to what a third party can pay towards those closing costs. Now, Terry had mentioned, I tried doing a roof repair recently and no carrier would bind a policy. We've had those come up as well too, Terry, where the insurance agent, we work with them, they agreed to bind the policy, provided the rest of the home had a clear 4-point. The solution of that the insurance agent gave us was get a clear 4-point. We have the contractor's invoice in the file for the roof, and then the roof was able to be done after closing with a clear 4-point on the rest of the home. So that's a good point, Terry. That could come up, and then you've got to have the insurance network set up where you have the contacts where there's multiple backup options if the first one will not do it for whatever reason. Okay. So that's a workaround we've come across. So thanks for that comment on there. Okay. So here's the side-by-side of the 4 programs. Okay. Now on this slide, I want to point out this recently, I left this up there because I wanted to show you this recently went from 0.85 down to 0.55 for the FHA monthly mortgage insurance and 0.50 if it's 10% down or greater. So on the left to right, you have USDA. It's a great side-by-side column. VA funding fee was just updated. Well, it's going to be effective this month. I'm going to show you the new funding fee chart as well too. That's for this section right here. You can see side-by-side USDA. Down here, as we're focusing on VA, look at the flexibility we have with prior bankruptcies, foreclosure, and short sales. A 2-year waiting period, which we can get that down to 1 year with exceptions and depending on those, what we call mitigating circumstances. So high flexibility with the program. So you can see side by side here, if you have that USDA and VA buyer, we got ultra high credit qualifying. We've got reduced borrowing costs for the two. And then most importantly, you're looking at what buyers are really drawn to right now. They want to buy, but they want to save on their out-of-pocket. So no down payment financing allows them to utilize as much of their funds for any of those TLC type of improvements, those cosmetic items they want to address after closing. Or what we're also seeing is when you compare, let's say the FHA or conventional, they're putting down payment and closing costs in many cases. Going with the no down payment feature under USD or VA allows them to have, if they have extra money, they can pay their own closing costs and help with their negotiations. So some great tools that are on the table right now. And going back to what Clarence said, we've got great programs. We have high buyer demand and very flexible situations can be crafted depending on each property with whether it's repairs, buyer eligibility. So that there's so many good things that are happening right now in the market. I want everybody to understand that and take away from that, if anything. And especially with that USDA and VA buyer, they are out there and they're in demand. So don't be scared, just be aware. Okay, so some of the tools we work with when we're properly qualifying. And so what I want to say, when I say that, I'm going to repeat that, a proper qualification. It says, when I say a proper qualification, it's not a 5-minute call with a loan officer where they take a look at their credit and say, you're good to go and send them a qualification letter. Those are happening right now. And we're seeing the qualification letters get sent into our office to see what happened on them. And they're not worth the paper they're written on in many cases. So be ultra cautious and have your guards up at this point in time in the market and make sure you're vetting as much as you can, the program, the lender, the loan officer handling it to make sure they've done as much of their due diligence up front as possible. So part of that is an automated underwriting system. What that does is, to give you the big picture on it, what the automated underwriting system does is it doesn't stamp an approval, you're approved, clear to close. What it does is we submit all of the buyer information into the underwriting system. It's going to provide back to us findings. And based on those findings, it'll give us a roadmap of what type of documentation we need, as well as how high we can go with our monthly payment, sales price budget. Because at the end of the day, you need to know, what's the price, Sean? How much can this buyer qualify up to? I need to start my search. I think I hear those words in my sleep. Sean, what's the price? Just give me the price. And I get it. That is the critical thing. And this is one of the tools we use to help with that. And this is the summary here I just mentioned. You have Fannie Mae desktop underwriter. You might have heard of Freddie Mac loan prospector. I'm not going to pull you in the weeds, but this is the different underwriting systems that are out there depending on the program and the product type. Okay, so I want you to focus on this. Here is, you see up here, approve eligible. That means the underwriting system has accepted the buyer's qualifications and permits and expand whatever, it accepts what has been entered into the system as eligible for the program. Now, we're going to talk about this in a moment. VA published guidelines for debt to income ratios are 41%. We can expand that based on a variety of factors, in part also with the underwriting system will permit. So you can see here, we're above that 41% threshold. In part, we have an approve eligible underwriting feedback through the underwriting system. And based on the other factors in the file, then we could grant expanded debt to income ratios based on those criteria. Now, as you go to the next one, you may have heard the term, has anyone, and this is just a yes or no, if everyone could throw on a chat board, who has heard of what's called manual underwriting? Just like it sounds, manually, it's a more intense review of the process. Has anyone heard of the term manual underwriting? Because this is where the separation is from lenders right now. This is where the experience comes in. If you have a 780 credit score, you get an approve eligible, you're ready to move forward in the process, everything checks the boxes, meaning that is a more straightforward path. If you get what's called a refer, okay? So I'm going to go back to that slide here, but let's look here. If this gets a refer, that means it's being referred back to the underwriter. And these are questions you should be asking your lenders, okay? If it's a new lender, let's say, and they've sent a qualification letter, these are questions you would be asking. That's why I'm bringing this up. These are checkpoint type questions you would ask. What are your minimum credit scores? Do you offer manual underwriting? Do you have experience with manual underwriting? Okay, those are the type of questions. So when you see this refer here, that's going to refer it back to the human being to apply a more rigorous standard of guidelines, okay? So it doesn't offer the same streamlined ability as an automated acceptance would on the previous slide. We're going to have a more intensive review of the verification of rent. We may support the file with any additional reserves the buyer has after closing, a more stringent rental history and verification, more stringent debt to income ratios. Job time can be a factor. It just is a compensating factor overall you can look at. How many credit accounts, what's their credit reputation look like? These are all the common sense factors we have to take into consideration. And as you and I both know, the common sense department in many cases is completely closed as you call around and talk to various companies around the country anymore. So we have the good news is at Metroplex Mortgage Services, the common sense department is still open and active. So we're applying common sense underwriting guidelines, which are provided for through VA, USDA, and whatnot, when making those prudent underwriting decisions. So here's that refer. This is going to be the trigger. And you can see we'll need to be working to keep that as close to that 41% for total expenses as possible. So these aren't things you're going to maybe be talking about. If I'm calling you and say, here's our budget, you're not going to say, Sean, I don't care if it's manual or automated. I just need to know the price. I'm showing you what goes into getting that number to you. This is under the hood. Okay. And I'm not expecting you to walk away and remember all this verbatim. I'm just giving you some touch points. So when you see those qualification letters, you can say, okay, what have they done in this file? You can call and talk to the loan officer if they answer the phone, or if they have an office to answer the phone. You can call and talk to someone and say, what has been done on this file? Tell me, have you run the underwriting system? Do you have documents in? Have you processed a certificate of eligibility? These are the questions you need to be answering or asking in today's market. And if they don't have answers, you need to have a conversation with your buyer. Okay, so I'm going to move on to part 2. We're going to be talking about VA eligibility, VA entitlement, and also the funding fee. Any questions, scenarios, even if you have a conventional FHA scenario, USDA, whatever scenarios you have, please, I love questions. I love to fix. I mean, right now, I've got different roles in the company. One of them not recently, maybe for the last over 2 decades, it's been the mortgage mechanic, because we're fixing things for other lenders. We're fixing problems. Under contract, this came up. Appraisal back, this came up. Credit report, this was missed. Credit related or debt to income, the income wasn't calculated properly. They didn't ask about child support. They didn't do this. We're seeing all of the bread and butter type issues again, how you make a mortgage. You're seeing all these qualification issues come to light with many, many lenders out there. Now, there's a lot of good lenders, but there's a lot of mistakes that are happening right now due to inexperience in part. Okay, so VA loans are provided by private lenders. Remember, VA doesn't pay for anything. VA provides a program, and approved lenders such as Metroplex apply the program guidelines. VA will guarantee a portion of the loan. Obviously, we talked about 100% financing, which is a huge draw. There's also highly flexible credit qualifying, and it has to be one of those eligible service members, which includes unmarried surviving spouse of a veteran who died on active duty as a result of a service-connected disability. Okay, so that's another category as well that can be eligible for the USDA or VA program. Certificate of eligibility. Many have heard that, and many are not sure what that actually means. A certificate of eligibility is, we can process that through the ACE system, which is called the Automated Certificate of Eligibility. We process that. Most lenders will have access to. Lenders can and should assist with this process. Shame on those lenders and brokers who tell the veteran to get their COE and send it to them. Shame on them for not taking this step in the process in managing this for the veteran. Sometimes we can get that certificate of eligibility depending on their service, their type of service, active duty, depending on their dates of service. If it's in the VA, if we might be able to get that instantaneously at that moment we request it. If not, we have to get the veteran documents to the DD-214, possibly other items. We can get that from the veteran, then we can submit on their behalf to get that certificate of eligibility. If we submit manually, that could take a week, maybe less, maybe a little bit more, depending on the facts. So certificate of eligibility, this is a foundational document in the VA process. So here's a screenshot of a certificate of eligibility, actually an actual certificate of eligibility with the veteran information redacted. So you can see here, this one piece of paper tells me so much information. Now, wouldn't it be nice if everything in life was all on one piece of paper? At the top, you can see this person is actually exempt from the funding fee, which we're going to go through here momentarily. And they have a monthly award, which is down here. So because of their service-connected disability rating, with VA, if you have at least a 10% disability rating or more, you're exempt from the funding fee. So you're really getting 100% financing pure. Okay, so there's no funding fee, there's no monthly PMI. You're buying a house for $300,000, you're getting a $300,000 mortgage if you put no down payment. So there's no extra cost onto it for the veteran. So this shows here that there is a prior loan outstanding that is still active. This is how much of their entitlement was used in order to have this loan amount and the date of the loan. Now, if they were not exempt from the funding fee, this veteran would have to pay a subsequent use funding fee, which is a higher percentage. But because they are exempt, that funding fee is waived no matter how many times they use their VA loan. And just to confirm, you can use your VA loan as many times as they're eligible to. Okay, there's no one-time use. We get that question, well, I already used my VA loan back in 1987. That's fine. We can reuse it again. Okay. And this all form also tells me how much their disability is per month. So we can use this. I always ask them what it is in case they've gotten any increases. For example, I was working with a veteran on the weekend and his certificate of eligibility said, I think it was 1,800, but he recently had a increase and it was close to 3,000. So he's getting us in his disability paperwork because the certificate of eligibility just has not caught up to his recent change yet in that situation. So we're always asking those probing additional questions. Here you can show who can be eligible for a VA loan. You have those different eras, World War II, post-World War II, Korean, post-Korean, Vietnam, post-Vietnam, et cetera. These are all the various categories that can be included eligible for a VA loan. And this is part of the process we go through is when we submit for that certificate of eligibility to establish that eligibility for the VA program. So as I mentioned, VA insures 25% of the loan amount. You may have seen the number 36,000 before. That doesn't mean VA only will give you a $36,000 loan amount. When you think about it, that's rather ridiculous. But VA will guarantee 25% of. So that's their entitlement. So VA looks at this as basic and additional entitlement, which is also referred to as bonus entitlement. Anything over 144,000 would consider bonus entitlement. So without getting in the weeds too far, if you have full entitlement, okay, let's say you've never used your VA loan or you've used it and paid it off. So you have no VA loans are outstanding. There are no loan limits with VA. We're working right now with a veteran who's purchasing a home where it's well over $1 million in their purchase price. So there is no loan limit and they can actually qualify to purchase that if they wanted to, and if they're eligible for it with no down payment. So highly flexible with higher loan amounts. This has been one of the greatest resources we've had for our rural areas. VA appraisers they're very common sense oriented. I've had great experiences with VA appraisers are very, obviously everybody's got their own opinion, but from a lending side, the VA process is amazing. So if anyone has it in the back of their head, VA loans are problems, VA loans can be your best asset, and you've got to be comfortable with this. And you don't want to turn away. The worst thing I can hear is when the veteran says, well, the realtor told me to get a conventional loan. That just tells me they're not comfortable with it. They had a bad experience one time with it, or they had a bad lending experience. So let's make sure we turn that myth around. Has anyone online right now, has anyone had the experience where the realtor said, just go conventional? It's not going to pass VA. We're going to talk about that here in a little bit too. So here's an example of where another reason why we get the certificate of eligibility is if we show if there's prior losses. Because if there was a prior loss, this was a foreclosure back in 1984. It's still a loss for VA until this gets paid back. Okay, you can see the loan amount there. Until this gets paid back, the amount of the loss and the claim, then that affects how much I can qualify that veteran for the VA loan. That affects the eligibility scale. There's different calculations that go into that, but this is another reason we get the certificate of eligibility, because it could also tell me a prior loss. Some of these veterans who had loans back in the 80s, they don't recall. They may have gotten, maybe whatever the circumstances were, some thought it was just taken care of until we get to this point where we're trying to go back into the VA to get them eligibility again. This can come up from time to time. So that's another reason why getting the certificate of eligibility as quickly as possible helps me give you the details you need, because all this comes back into what's the price. All this factors into how much they can qualify for. Has anyone in the group had issues with certificate of eligibilities or the lender not getting them until later in the day or later in the process? Most times it's not even the same day. It's going to be weeks down the road. All right, so that's the background on the certificate. That's the background on entitlement. So now let's jump to VA funding fee. So VA allows, funding fee is a one-time fee that they allow to be included with the loan as part, and it becomes part of their loan. The funding fee is used to cover liquidation losses to VA. Certain veterans can be exempt from that funding fee, as we talked about on that certificate of eligibility example. PMI is not required. Conventional loans have PMI, FHA has that mortgage insurance premium, and USDAs have that monthly premium. Vivian, that's tough to hear. I'm sorry for that. Yeah, it's frustrating when I hear that it's not going to pass VA when we have so many potential ways to make it that it can be eligible for VA. We're going to talk about that. Let me get to that slide as we get through. We're going to talk about minimum property requirements and some of the myths. So VA funding fee is being updated on April 7th. So this is on or after April 7th for loans that are closing. So you can see here, remember I had that verbiage in there, subsequent use. So if someone's getting a 10% down loan and they're using their VA loan for the second time or more, look, it goes from 3.3 up from 2.15 the first use. Refinances right there. There's other types of funding fee percentages down here as well. As you put more money down, that funding fee drops. That can be paid out of pocket, but the big draw is VA does allow that to go into the loan amount. Okay. So they allow it to be financed. So if you had a loan amount of $300,000, purchase price $300,000, loan amount of $300,000, and the VA funding fee would go on top of the loan amount, regardless of what the home appraises for. Let's say you had sales price of $300,000, you had loan amount of $300,000, appraisal of $300,000. You can stack the VA funding fee on top of that. All right, as we move on to part 3. Any questions on funding fee, VA eligibility, entitlement? Another checkpoint, yes, Clarence, unless you are exempt, then in that example, $300,000 sales price, $300,000 loan amount, $300,000 appraised value, no funding fee, it's just $300,000 across the board. So if you're exempt, there is no funding fee calculation. Donna has a question there. I've had many of us turn out for you, even though it was perfectly great. Donna, you're reading my mind. I have a slide on manufactured modular homes. So I'm going to keep you posted there for a minute. We're going to get to all those questions that you just asked here momentarily. We are working with so many manufactured homes right now. VA is an amazing program. There are some lenders that really just cut the deal and they will not work with manufactured homes, or they try to, I've had this come up numerous times here in the last 4 months, where there's certain lenders that try to push the veteran to a single family home, which in many times can be higher cost. Okay. So let's get through this and we're going to get to that slide here momentarily. So here's our debt to income ratio. We talked about this. You're not going to see the back end of this. This is what we're looking at: pay stubs, self-employment, VA, disability, retirement, Social Security. We're looking at total income. There's something called residual income, which is the amount of income left over. We're doing all this calculating. These are things that the lender should be doing proactively at the beginning. Because as I said before, all of these slides in some way, shape, or form contribute towards eligibility, qualifying, and in the end, their sales price. And then student loans, there's separate VA has a separate calculation for student loans. When you start moving between loan programs, conventional, FHA, USDA, VA, you have to be in the know about how student loans are calculated and how each program can impact them differently. There are different types of loan repayments, some called income-based, income-driven. Is it forgiven? Is it not? That's a huge topic that's coming up right now, or some people think their loan's forgiven. It may or may not been. It's deferred. There's different guidelines for each. This is something we work with. And once again, having the proper calculation in there affects your debt to income ratios, and that affects your sales price. So making certain your lender is up to speed on the relevant guidelines. I mean, the handbook is intense. I love it because I love our market right now too, because you have to know what you're doing from the lender side for these transactions to be successful. Especially when you're in our rural markets, you have to have that additional layer. I'm seeing mistakes come up because lenders think roads are private. They think they're not. Just because it's dirt doesn't mean it's private. How do you handle that? So I love the market right now because you have to have the experience to be successful with what I'm seeing. Okay, and here's that VA residual income. This is basically the amount of money that has to be left over after we go through and do calculations. So once again, something you're not going to have to do, no, but just want to just throw this out there so you have at least the verbiage and a visual that these are additional items we look at when we're qualifying. Now, credit qualifying. Credit qualifying is less stringent underwriting guidelines compared to conventional. It doesn't mean anyone's getting a loan. You still have to have minimum credit reputation. You have to meet minimum credit qualifying to be qualified in the first place. High credit score flexibility. VA does not publish a minimum score. VA lenders such as ourselves will have minimum scores, which are subject to change. So right now we're looking at minimum scores of 580 and above. Many lenders right now we're seeing 620 or higher. And we're hearing rumors that the lenders will tell the buyer VA requires this. It comes down to the lender. We are highly flexible on that. And we really look at the file in a common sense manner. In less stringent waiting periods we talked about for those bankruptcies, short sales, and foreclosures. Has anyone had a VA buyer denied recently because of credit or debt to income ratios or property type, manufactured home, for example? If you have, please say yes or no on the chat board, because these are coming up more and more as the months go by. We can actually qualify with no credit score through building what's called alternative credit, where we can utilize the veterans. We had a zero credit score buyer close in February, where the previous lender said we could not work with it. They could not work with the veteran. The veteran had a zero score and their spouse had a score. In mortgage qualifying, you take the lower of twos. You have to apply zero credit score guidelines. So we're able to work with that through establishing alternative credit, rental history, electricity, cable, cell phones, those type of things. And we're looking at the file and we're going through a process where we're putting those into formats we can utilize from an underwriting standpoint. This is really old school technique for those of you who've got the experience, who may be familiar with this. This is called building credit. And I dig into this into my credit class. And we're either going to be doing a credit class next or a USDA workshop, either one of the two. So what this shows is we've taken 3 accounts of the veteran and we've put them into what's called a supplement. This is a credit supplement. This doesn't go on to someone's credit report at Equifax, Experian, or TransUnion. We get their contact information for the creditor. The veteran, our credit company, will get on a 3-way call and they'll verify payment history. And through that, we are able to show this is how long they've had the account open, how many months. We're looking for at least 12, and this is your late payment or no late payment history. So right here, we have 0 late payments, 0 late payment, 0 late payments. Here's a cell phone. Here is a utility company, Duke Energy. We got Bright House and T-Mobile. So that's called building credit. So anyone that has limited credit, this is a great resource. If you have bad credit, you can't build credit to offset bad credit. All right, so here's our Chapter 7 bankruptcy. We spoke about this before, 2 years from discharge date. There can be exceptions to that. Chapter 13s are unique. If you ever come across a buyer where they have a Chapter 13 bankruptcy, that is where there's a payment plan they're in to pay back the bankruptcy instead of discharging as in a Chapter 7. So you have the payment plan before the discharge. So VA will allow you to, once they've had 12 payments in the bankruptcy plan, you can actually get a loan while you're in the Chapter 13 bankruptcy plan, provide those 12 payments, and the bankruptcy trustee grants permission. We have worked with Chapter 13 situations like this over the years. So if this ever comes up, if you hear the words Chapter 13 from your buyer come out of their mouths, get us connected, because there's particular guidelines. Most lenders lump together bankruptcies into one, but there are particular guidelines for Chapter 13 versus Chapter 7 specific. So Chapter 13 can allow for more flexibility with how soon you can qualify after filing. So interest rates too, Don, interest rates are going to be based heavily on credit score as well too. We're seeing, just generally speaking with rates, we're seeing VA, USDA, government rates can be significantly more favorable than conventional because of all the various rate adjustments that get factored into the conventional side. So obviously USDA VA loans are not for everybody, but for those that qualify are taking advantage of better borrowing cost, better rate calculations right now. So there's really that affordability is on the forefront. Your foreclosure deed in lieu of foreclosure and short sales, you have 2 years after those dates. You have a 2-year window. And then there's a system called CAVERS. You may or may not have heard of this. This is a system we check to make sure if there was any previous foreclosures, bankruptcies, any government debt has cleared the system. SBA loans, FHA loans, USDA loans, student loans for government, any of those government type obligations that may went into collection. This is another system we utilize. And once again, all this comes back into getting the eligibility, making sure they qualify. And then when they get in your car on the weekend, you know it is a properly qualified buyer that you're maximizing your time with, and you're working towards the end goal of home ownership for that client. So when they get in your car, they're following you in their cars, you want to make sure the time spent is well worth it, and it's a qualification you can count on, because that's what we're giving to our veterans and our realtors, is that local competitive advantage that they are able to rely on day after day, week after week, month after month, year after year, and now decade after decade. So part 4, we're looking at no down payment, termite inspections, commonly known as WDOs, wood destroying organisms, VA minimum property requirements, multiple parcels, manufactured homes, condos, and private roads. So we got a lot to pack in these last few minutes here. So here we've already talked about what does 100% financing mean. We've talked about the no down payment. We've talked about the funding fee. We've talked about seller paid cost. What's important for me to focus on when we're talking to buyers as well is there is confusion. Many buyers think 100% financing or no down payment is the same as no money out of pocket. We break down with them down payment versus closing cost, earnest money deposits, appraisals, inspections, those type of things. So they are fully aware of what the out of pocket expenses can be in the process. Now, here's a common question. Now, regardless of what your sales contract addendums may say, this does vary from state to state. For example, in Florida, can a veteran pay for the termite inspection? Yes, they can. The buyer, the seller, the realtor, the buyer, veteran can pay for it. So Florida, Alabama, and Texas have carved out exemptions to their general rule. Generally speaking, the veteran is not able to pay for the termite, but there are certain states which allow for exemptions to that. As a result, the termite inspections can be paid by any party in those states, the veteran, the seller, the realtor. So when you're writing the offer, someone says, what's the difference, Sean? 80, 100 bucks, $90, 75? What's the difference? Who pays for it? When you're writing that clean offer and you're in multiple offers, anything you don't have to have the seller agree to additionally, we found has been a huge advantage. If you can write a clean offer, come in with a competitive price, no contingent, like no extra cost the seller has to absorb, then that gives the veteran at least a chance to be competitive on the offer. If you start asking for the sun, the moon, the stars, then plus maybe the price is not where it needs to be, obviously put two and two together, that's going to be a tough offer to get accepted if there's competing offers that are stronger. So anytime we do not have to have the seller do anything, if that's how you want to negotiate it, this gives an advantage for those certain states. And then here's our minimum property requirements. Let me go. I don't necessarily like reading from the screen. Let me go through these. I pick some of the hot topic items out of their NPRs, but if you want to look at it, you can always go to the VA pamphlet. And if you got that time on the weekend, you want to spend time reading, here is where you go to find these highlights. So minimum property requirements are also referred to as NPRs. VA has these to protect interests of veterans, lenders, servicers, and VA. Property must meet minimum property requirements. A key word that you want, a key phrase you want to remember is safe, sound, and sanitary. So we want the goal of minimum property requirements is to ensure the property is safe, structurally sound, and sanitary. So you want to, when you're going around looking at the property, do you see wood rot? Are there cracked windows, foundation concerns that you have? And remember, an appraisal is not the same as a home inspection. We're right here for those of you following along. Now I'll read that. You see the bolded. The fee appraiser will not perform operational checks of mechanical systems or appliances. This is not to be substitute. So VA does not require home inspections, but they do highly encourage it, as do we, and majority of realtors we work with as well too. So now down to cosmetic items. Another question we get routinely. The appraiser, VA guidelines state the appraiser should not recommend repairs of cosmetic items, items involving minor deferred maintenance or normal wear and tear, or items that are inconsequential in relation to the overall condition of the property. So they may consider that in the value, minor repairs should not be recommended. And we're going to talk about multiple parcels here on the next screen. Detached improvements. This is another question we get. Let's read this. Detached sheds or other improvements on the site may be included in the value if the improvements meet VA minimum property requirements. If it doesn't, it must be excluded from the value. And the question is, Sean, does this have to be fixed? If it presents health or safety hazards, then it may be completed to the appraisal will be subject to them removing those concerns. So these are highlights of some of the questions we routinely get. So VA is not the nemesis of the appraisal process. On the other hand, VA appraisal process is, in my experience, found to be highly flexible and really more common sense than they're given credit for. Now, here's your multiple parcels. Can you include multiple parcels? Here's a screenshot of a scenario we had where you can see the house in the middle. And then they were trying to sell, this owner sold these two homes. So yes, we could combine all three of these into one transaction. You can see here multiple parcels, more than one parcel or lot may be included. I'm in this top section here on the left of the screen. As long as the property is contiguous and legally marketable. Contiguous, they're all here connected together. And that all lots are contained in one deed at closing. So it's likely there would be, the appraiser would say, yes, we can do these multiple lots subject to it being contained in one deed at closing. So anyone that's getting, this comes up very heavily in rural areas where you've got connected lots and they want to tie those all together. Now, this is not the same guideline for all programs, okay? VA, USDA, conventional, everyone's different. So make sure you're working with your lender and they are competent on this subject. And Donna, here is our slide. Okay, manufactured homes. Here are some highlights. So real estate entity. The manufactured home obviously cannot be in a park. Okay, it needs to be considered real estate. We have to have that permanent foundation. The VA appraiser will go out there. I would suggest one of the questions we get on manufactured homes. Now, remember, this applies to both single wides and double wides. You see here, you must have at least 400 square feet for a single wide or 700 square feet for a double wide. Those are the size restrictions, which I don't have any, I've not seen any issues with meeting the size restrictions with that criteria. And it must meet HUD standards for age and year built as well too. So June 15th, 1976 is that date. And really a tremendous asset for those rural areas. We are working with manufactured homes month after month, both single wide and double wides. And many realtors are completely blindsided what a phenomenal tool this can be for that product type. It's really, and I would say too, a lot of the questions I get was, should we do a structural engineer report? You can if the buyer wants to. I would say if you have to do it, depends on the VA appraiser when they come back, if they would stipulate for that. So really a highly flexible, before you start doing structural engineer reports, unless the buyer wants to at the outset, wait for the appraisal to come back. And I want you to know that manufactured homes is alive and well under VA. It's a great program for that and provides an additional layer of flexibility. Modular homes are not the same as manufactured homes, as you know. They must meet state and local building codes. And if you can see down here under comparable sales, I'm at the very bottom of the slide. The appraiser will typically treat modular housing and on-frame modular housing in the same manner as conventionally built housing. They're going to select comparable sales that would be competing properties on the market, which may include modular homes, conventionally built homes, or manufactured. So modular homes, different than manufactured housing. Donna said, my VA bar is denied for his chosen manufactured home on a small acreage, so he ended up going a conventional loan. Yes, that was, I don't know all the facts on that, but that would be something I would have concerns on just on the scenario. VA approved condos, we'll keep this one, we're running out of time, so I'll keep this one. This doesn't come up too often in the areas we're in, but it must be VA approved condo, and condominiums are a form of ownership, not a specific property type. There's some communities that are manufactured homes in a condominium community. Okay, those can be eligible, but the condo has to be approved by VA. So here's the link for the VA approved condos. And if you wish to get a specific condo approved, there are particular process we go through for that. Please let us know and we can help in that matter. So private roads. Okay, another topic that comes up in our rural areas. Private roads may or may not require what's called a maintenance agreement depending on the program. So private road, let me answer Donna's question real quick before we turn the page. So many times we just get that we don't loan on manufactured homes. That is that lender's criteria. That is not VA's criteria. And I'll tell you for a fact, that's not my office criteria, because we are lending on manufactured homes with VA loans constantly. It's a huge product type. So maybe we can set up a call after this, Donna. We can go through additional steps in that process just to get you as much comfortability as possible. So private road maintenance agreements, here's something you need to be aware of. When you're listing a property or you're working with a buyer, if it is a private road maintenance agreement, VA requires it unless there's a waiver. What that is basically a private road maintenance agreement is an agreement between all the owners on the road, how they're going to maintain the property. Fannie Mae requires it. Freddie Mac, FHA, and USDA do not. So if you have a private road, there's additional stipulations down here for these. But if you have a private road and you have questions, then reach out to us. We deal with private road questions all the time. There are some roads that are technically public that realtors think are private. And so, so Freddie Mac, FHA, USDA, we're going to need evidence of a permanently recorded easement. Clarence was right on that for ingress and egress. In any private road questions, I love these questions because this is another separation. This is what's helping people get into homes, is understanding the criteria and the guidelines, where I've seen some underwriting emails get forwarded to me from other lenders that say we can't do the loan because it's on a dirt road. That's not a criteria in and of itself. And here's an example of getting that waiver approval. So although VA generally requires that for private roads, they do have circumstances where we can gain a waiver once the appraisal has been completed. Okay, and this is part of the waiver approval for a private road joint maintenance agreement. So VA can allow that as well too. So VA lender port, and this is what we use. This is a screenshot of what we use to order the certificate of eligibility request, appraisal request, condo and builder status. And I will get that link for approved condos when we finish up. I'll put that on the chat board. All right, we're in a summary page here. So VA loan is highly beneficial. We talked about 100% financing, no PMI, flexible credit qualifying, flexible seller concessions, availability for higher loan amounts as well. And some of the things we do from our standpoint, we properly qualify the buyer before they get in your car. The home search begins. They make application. We handle all the underwriting in my office, which should give you a huge level of relief because we're that one point of contact from contract through closing for the qualification, the underwriting, the processing, ordering closing documents, getting the preliminary closing disclosure out to the buyer, and then going to closing. And I put a slide because mainly the question I get is, Sean, what's the best way for us to get a buyer connected with your team? So if the best way is to get permission for us to contact them, then just call, text, or email and say, Mr. and Mrs. Smith are expecting your call. Please reach out to them as soon as possible. Then we begin to follow up. For those of you who aren't familiar with my office, I have a team. I don't have outside loan officers out there in the field. We have a dedicated team in the office for our qualification, and then it just moves right down the hall into processing, underwriting, and closing. So we manage the file. We have a team approach where we're all working on our files to help really further. So like right now, while I'm teaching this workshop, phones are ringing, calls are being answered, emails being responded to, buyers are being assisted, qualifications are being processed. The wheel keeps moving. However, if the buyer does want us to contact us first, just let us know their name and we'll be on the lookout. And we look at the homeowner assembly line and we break it down into various parts of the process, just like an assembly line. You got to create that successful referral, call, email, text us with permission, then we'll start following up with them. And then we are known for keeping our realtors in the loop at each stage of the process. You begin to shop for a home. You know that qualification is one you can count on. We've done our qualification up front with income, credit, automated underwriting system. You get them under contract with a qualification letter that, once again, you can count on. Sales contract received, and we move into underwriting and processing, getting appraisals ordered right away. For example, getting loan documents out to the buyer in the morning, getting those back in the afternoon, getting appraisals ordered by that night. Same day appraisal orders is not a possibility, it's a reality. Getting title and survey, coordinating the loan processing, underwriting, and moving to the closing table. So these are all of the bread and butter tasks that we do day in and day out to help with the process. All right, everyone. I want to wish everyone to have a great rest of the day. Any questions, we're here. Call, text, email, whatever's easiest, so we can go to work for you. Have a great rest of the day. Have a great rest of the month, and we'll talk to you soon.